assets will be translated using closing rate. This is the basic concept. Can we apply the exchange rate here? If there's any impairment, will be translated using 7.8. Goodwill at the year will be translated using the closing rate 8.1. There's no impairment loss. If there's any impairment loss, you minus 7450 multiplied 8.1. The goodwill is equals to 60345. The goodwill at the acquisition is translated using 7.6. The same amount of goodwill at the year is translated 8.1. The goodwill is the same, but the exchange rate is different. As a result, there's a translation differences. At the start, the goodwill is only 56620. At the year end, the goodwill is equal to 60345. The goodwill increased by 3725. This 3725 represents a translation gain. Assets value is higher, so it represents a gain. This translation gain should be recognized in OCI, but bear in mind, if there's any impairment loss, the impairment loss must be recognized in P&L. This is the figure that we need, 3725. The translation differences on goodwill is 3725. And now we have to calculate what's the translation differences on patent and deferred tax liability. These are assets liability of the subsidiary. Earlier on we calculate goodwill, we look at patent. The patent initially is translated using 7.6. Take the patent down, patent assets. The patent assets must be expressed in the functional currency of the subsidiary. At the acquisition date, the patent assets is equals to 10 million Aussie dollar. Initially, it's translated in presentation currency at 7.6, the HR rate, which is Hong Kong dollar 76,000 dollar. The patent have a remaining useful life of 10 years. Every year, we must account for amortizations to profit and loss. $10 million over 10 years account for $1 million amortizations. When we make adjustment, we must adjust in the functional currency of the subsidiary. The carrying value of the patent at 31st December 2012, there's a remaining 9 million Aussie. When we talk about adjustment, it must be in the functional currency of STL. Now we'll talk about translation into presentation currency. Amortization is an expense. Expense will be translated using the average rate. Patent at the year is an assets. Assets at the year will be translated using closing rate. Applying the exchange rate, average rate for the year is equal to 7.8. The closing rate at the year end is equal to 8.1. The translated amortization charge to P&L will be equals to 7,008. The translated patent assets remaining at the year end, 9,000 multiplied 8.1, is equals to 72,900 Hong Kong dollar. So after that, we have to calculate the balancing figure. 76,000 minus 7,008 minus 72,900. There's a difference of Hong Kong dollar 4,007. After translation, assets value is higher. When assets value is higher, this represents a translations gain. This gain will be recognized in OCI. This is the figure that we need to calculate. 4,007. As a result of the patent assets, we must account for deferred tax liability. At the acquisition date, we account for deferred tax liability of 3,000, translated at 7.6. Can I take this down to show as a separate working? We do have a deferred tax liability as a result of the patent assets. It must be expressed in the functional currency of the subsidiary. At the acquisition date, we account for deferred tax liability of 3,000 Aussie dollar, and this 3,000 is first translated in presentation currency at HR rate, which is equal to 7.6. Translated amount is equals to Hong Kong dollar 22,800. I put as a minus because it's a liability. As a result of the patent amortizations, we lower the taxable differences. As a result, we should lower our deferred tax liability, transfer this to P&L as a tax adjustment. This is a tax adjustment in profit and loss. Taking 1,000, multiply a tax rate of 30%. The deferred tax adjustment is equals to 300. Thereafter, this will be the carrying value of the remaining deferred tax liability at the year end, a minus of 2,007 Australian dollar. We must translate from functional currency to presentation currency. This tax is a tax adjustment to the income expenses. This will be translated using the average rate. The deferred tax liability at the year end will be translated using the closing rate. Applying the exchange rate, the average rate for the year is equal to 7.8. The closing rate at the year end is equals to 8.1. 300 multiplied 7.8 equals to 2340. The closing deferred tax liability is 2,007 multiplied 8.1. Deferred tax liability at the year end remaining is equals to 21,870. Now we have to calculate the balancing figure. 22,800 minus 2340 minus 21,870. There's a difference of 1,410. Liability is higher. This is considered as a translations loss. This translation loss will be recognized in OCI. This is the exchange differences that we need. The translation differences on the assets is equals to 4,007. The translation loss of the deferred tax liability is 1,410. 30,000 plus 4,007 minus 1,410. The total translation differences is 3,3290. And the translation gain on the goodwill is equal to 3,725. Total is equals to 3,7015. These translation differences will appear as part of OCI. How much do we let NCI share? 20%. NCI always share the net assets of subsidiary, so NCI will share the translation differences of the net assets of subsidiary. NCI will share this amount 20%. 33290 multiplied 20% is equals to 6658. Does the NCI share this goodwill? Answer is no, because this is a partial goodwill. If NCI do not share the partial goodwill, NCI do not share the translation differences on goodwill in this case. NCI do not share. In total, the NCI share of the translation differences is 6658. The amount that belongs to the parent is the balance. We take this amount minus this, equals to 30357. This represents parent share. So this was part of the translation differences reserve account. Part B will require to do the worksheet. Your job is to fill in this column and put in the adjustment entry. The objective of going through this worksheet is to have an overview and better understanding on the translation process so that you can explain the issue in the exam for Module 11. Again, please take note that those figures in credit are shown in bracket. For example, share cap, retained earning, translation reserve, liability. Hence, please bear in mind, those in positive represent debit balance or debit entry. Those in negative represent credit balance or credit entry. MHL column is given in the question or given on the template itself normally. But the SDL column is not given. SDL column is the translated column. This is from part A of your own answer. This column will be used for part B. Translated amount for non-current assets 615,600, inventory is 48,600, account receivable is 97,200. All these will be used for part B. 615,600, inventory, receivable, cash, share cap, retained earning, translation differences we calculated earlier on, non-current liability, current liability. So that's the first step. The second step, obviously we must do the consolidation adjustment. Adjustment 1 is always for us to calculate goodwill. 3. We have all the figure. You don't need to show any more working. It's all there on part A. Number 1, that's the first adjustment entry. Eliminate the cost of investment. We must account for NCI. We must eliminate share capital retained earning at the acquisition date. We must increase the patent value. Account for deferred tax liability. So the balance is the debit to goodwill. These are the figure that we use for part B. Put it here. Eliminate the cost of investment. Account for NCI 92720. Eliminate share cap retained earning at the acquisition date. Increase the patent assets as part of non-current assets. Account for deferred tax liability. And the balance is the goodwill. Adjustment number 2 is the post-adjustment entry. Number 2 is to adjust for amortization of patent assets, adjust for the tax effect of the patent assets amortizations, and to let NCI share. Account for amortization of 7,008, credit patent, debit profit and loss, means retained earning, debit the deferred tax liability, credit our profit and loss. The net amount of these two multiplied by 20% equals to NCI, 1092. Entry number 3 is to account for the translation differences on goodwill. Entry number 3, 3725. Debit the goodwill because translation gain, and credit translation differences reserve account. Entry number 4 is to account for the translation differences on patent assets as well as translation differences on the deferred tax liability. Entry number 4. Entry number 4. So increase the patent assets because of translation gain, increase the deferred tax liability because of translation loss. The net of these two will be equal to this. It's a translation net gain to translation differences reserve account. Entry number 5 is to let NCI share the post profits. The post profit for a year is equals to 78,000 multiplied by 20% equals to Hong Kong dollar 15,600. This is NCI share. This will be entry number 5. Debit profit and loss, credit NCI 15,600. Debit profit and loss, credit NCI. Take and put it here. And the last entry is to let NCI share the translation differences of 6658. This is entry number 6. If you want to know the debit and credit, you can refer to the notes, entry 1, 2, 3, 4, over here. Add it up. I just want you to pay attention on a few figures here. First is the goodwill. This is the translated consolidated goodwill, 60345. This amount is the same figure that we have earlier on, over here. Another figure that you have to take note is the NCI, 113886. So this answer, in order for us to do the worksheet, you must have a set of working. This is the working that you should produce. You can think about the usual working that we use so far when you do consolidations. Can I demonstrate to you? SDL net assets. Here is 31st December 2012. We need to know what is the share cap and retained earning now. The share cap retained earning now is always on the balance sheet. Based on the information given to us, share cap now is equals to 24. And the retained earning of the subsidiary SDL is equals to 40. After that, we must work back to the acquisition date. The acquisition date is on 31st December 2011. Share cap at acquisition date is 24. The retained earning at acquisition date is equals to 30. The total of this is equals to 54. This is equals to 64 net assets of the subsidiary. At the acquisition date, we say there's a patent assets of $10 million. As a result of this patent assets, we must account for deferred tax liability of 30%, which is minus $3,000. The net assets at the date of acquisitions, 54 plus 10 minus 3, is equals to 61. This represents the fair value net assets at the acquisition date. This is considered the pre. Now we consider the post. The post is for 12 months. From the acquisition date to the year end, there's a post profits of $10 million. Then after that, we must account for the additional amortization depreciation of the patent equals to 1,000. I put depreciations. As a result of this amortization depreciation, we must account for the tax effects, which is 300. When it comes to year end, the unamortized patent is equals to remaining of 9,000. And as a result of this 9,000, we must account for remaining deferred tax of 2,007. This will be the ending amount. Australian dollar is equals to 7,300. This figure are in Australian dollar. Now we talk about in presentation currency. At the acquisition date, the exchange rate is equal to 7.6. And for the year, the average rate is equal to 7.8. At the year end is equal to 8.1. We must apply the HR rate to all this figure. We must apply the average rate to all this figure. We must also apply the closing rate to the assets liability at the year end. Multiply by 7.6, we should have Hong Kong dollar 182,400. The retained earning multiplied by 7.6, we should have Hong Kong dollar 228,000. The patent recognized initially at acquisition will be translated 7.6 as well, equals to Hong Kong dollar 76. The deferred tax liability translated to presentation currency will be equals to 22800. The net assets translated consolidated at 7.6 will be equals to Hong Kong dollar 463,600. Those in pink are the translated amount. Profit for a year will be translated 7.8 equals to Hong Kong dollar 78,000. The patent amortization adjustment will be translated using 7.8. The translated amount will be equals to 7,008. As a result, we must account for the deferred tax effect. 300 multiplied by 7.8 is equals to 2,340. We add up all this, 10,000 minus 1,000 plus 300. So the adjusted profit before translation is Australian dollar is 9,003. This 9,003 will be translated for the year is 7.8 average rate equals to Hong Kong dollar 72540. Net assets at the year end will be translated using the closing rate 8.1. That gives us Hong Kong dollar is 569,430. Now we can calculate balancing figure. Take this minus this. We should have a balancing figure of 463,600 plus 72540 minus 569,430. Be a difference of a plus Hong Kong dollar 33290. This 33290 is the same 33290 we have earlier on. Over here. There's one more item to complete this working, obviously it's the goodwill. Goodwill at the acquisition date is recorded at 7450. Goodwill at the year end is also recorded at 7450. Goodwill at the acquisition date is translated using 7.6 equals to Hong Kong dollar 56620. The same goodwill is translated at the year end using the closing rate. So they give us 60345. If we take this minus this, there's a translation differences like what we calculated earlier on, a plus of Hong Kong dollar 3725. This is a figure that we calculated earlier on. I just put them together to show you as part of the usual working that we normally use. Can I put this in a diagram? MHL, investment in STL, 80%, NCI is equals to 20%. At 31st December 2012. First, we look at the net assets of the subsidiary before translations is Australian dollar 70300. And the goodwill before translations is equals to 7450. And this is translated at closing rate 8.1. Hong Kong dollar is equals to 569,430. The goodwill at the year is translated using 8.1 as well, equals to Hong Kong dollar 60345. This is the figure translated, consolidated 100%. Then we must account for NCI. NCI share this amount, but NCI do not share this amount. NCI only share the net assets, do not share the goodwill because it's a partial goodwill. We can take 20% of this amount, 569,430, 20%. NCI is equals to 113,886. We check. 113,886. And the amount belongs to parent will be this minus this equals to parent. 80% equals to 515,889. This 80% is 515,889. This 20% is 113,886. Part C. Assume MHL sold 50% of STL for Australian dollar 45 million on 1st Jan 2013. And the remaining 30% has a fair value of $26 million. These are considered as disposable of share. Is 80 minus 50 equals to 30. This is considered as loss of control. Must do a deconsolidations. We discussed that in earlier sessions. Can we do that now again? Loss of control. We have to look at in the financial statement of MHL and in the financial statement of the group. What must we do? In the financial statement of MHL, this is a disposable of investment. If it's a disposable investment, we account for the gain or loss on the disposable. Debit cash, they sold the 50% for 45 million Aussie dollar multiplied by the spot rate. Assuming the spot rate at 1st Jan 2013 is 31st December 2012. This is equal to 8.1 spot rate. 45 multiplied 8.1 is equals to Hong Kong dollar 364,500. And credit investment. The investment recorded in the financial statement of the parent is 427,500, represent 80%, and the parent sold 50 of the 80%. 427,500 multiplied 50 over 80. That gives us 267,188. There should be a difference of Hong Kong dollar 97312. This is a gain. This gain should report in P&L of the parent because it's a disposable investment. At the group level, do we still have control? Answer is no longer have control. If it's no longer control, you must do a deconsolidation, derecognize NCI. Then you must compare the current value of this to the fair value, any gain or loss recognized in P&L. In the financial statement of the group, there's a loss of control. We must do a deconsolidation, the usual step. We must reverse these two amounts because at the company level it's disposable investment, at group level it's not disposable investment, it's a loss of control. Debit back the investment 267,188. Reverse the gain on disposable investment 97312. Assuming the remaining 30%, we still have significant difference, debit associate. And this must be recorded at fair value. I've given you the fair value is equals to 26. Apply the spot rate 8.1. Associate is equals to 210,600. Then we have to derecognize the NCI. We must remove the assets liability consolidated. This one must take it out. Debit NCI equals to 113,886. Credit the net assets consolidated, and now we have to deconsolidate is this amount and this amount. Hong Kong dollar 569,430. Credit goodwill is equals to 60345. Add it up. There should be a difference of 59211. This represents the gain on loss of control. What is this gain about? It's using this formula. So the 50% for 45, the remaining 30% is 26, transfer to associate. Multiply by 8.1. So that gives us Hong Kong dollar 575,100. This 575,100 compared to this 515,889. There's a difference of 59211. This 59211 is the difference between the current value and the fair value. Upon loss of control, there's one more step for foreign operations. We must reclassify the translation differences from OCI back to P&L. This is the translation differences belongs to the parent. When the control is lost, must transfer this from OCI back to P&L. So there's one more adjustment entry. Debit OCI, credit profit and loss, 30357. When the control is lost, reclassify the translation differences from OCI back to P&L. Look at the last issue, D. What if SDL is considered an associate from 31st December 2011? If SDL is an associate, then we do not consolidate. We have to apply equity method. When we apply equity method, you must translate, then you apply the equity method. Translate, then apply the equity method. Can I show it to you here using this example? If it's associate, we do not consolidate, we only share the post profits. D. What if SDL is an associate? We just need to pass one entry. Debit investment in associate. Credit share of profits to profit and loss. The adjusted profit is this amount, 72540. Adjusted, translated, we share. Australia dollar, 10 million minus patent amortizations, 1 million. Then we must account for the tax of 300. This equals 9,003. Then we translate this using the average rate, 7.8, multiply by 80%, assuming we use equity method, 58032. We also share of OCI. We share this 80%, but this is already at 80%. The translation difference on assets we share 80%, but the goodwill is already at 80%. 33290 multiplied by 80% plus the 3725. This is already at 80%. Translation differences we share is equal to 30357. The total of these two will be equal to 88389. This will be the adjustment entry if SDL is an associate. If you refer to the statement of profit and loss and other comprehensive income for 31st December 2012, revenue X dollar, cost of sales X dollar, and so on. And after that, you have this share of associate profits, 58032. Profits for the year, X dollar. Share of associate OCI, 30357. Total comprehensive income. In the statement of financial positions at 31st December 2012, under the header non-current assets, associate, the cost is Hong Kong dollar 427,500 plus share of the profits, share of OCI 58032 and 30357. Add up these two figures, it should give you 515,889. If it's an associate, this is what you need to do. Associate in the profit and loss is share of associate profits, share of associate OCI. In the balance sheet, you have this line called associate. And if you look at this figure here, it should be a figure that you're familiar with. It's the same figure we have here. For this question, I add in two more issues. Part C. What if MHL sold 50%, resulting loss of control? Do the usual step to account for loss of control, but one more step, reclassify the previous translation differences from OCI back to P&L when the control is lost. Part D. What if STL is considered associate? Associate, you must use equity method. Before you use equity method, you must translate, then apply the equity method. If it's subsidiary, you must translate, then apply full consolidations. Please refer to page 314, question 10.7. A module A question is to discuss the factors to consider and the effects on the change of functional currency and for the change in presentation currency. Study the questions, understand the issue. We're going to discuss this question shortly. For these questions, the financial year end is 31st March. PHL set up a new subsidiary, KML, on 1st April 2018. For the first year of operations to 31st March 2019, KML made all its sales, purchases, rental, labor in Indonesia rupiah. In accordance to AS21, after considering the preliminary factors on sales and costs, it suggests that the Indonesia rupiah is the functional currency of KML. And KML presents its financial statement in Indonesia rupiah that represent the presentation currency. However, due to the volatility of the exchange rate, the main customer and supplier of KML insists on 1st April 2019 onward to determine the price and pay in US dollar. Since the sales and the cost of KML will be substantially in US dollar will become the functional currency of KML from 1st April 2019. For these questions, first issue is before that the functional currency is Indonesia rupiah. After that, the functional currency become US dollar. This is a change in functional currency. In accordance to AS21, the functional currency of entity should only change if there's a change in the preliminary account environment in which the entity operates. So this change is considered as allowed in accordance to AS21. Before that, the sales and costs are substantial in rupiah, but from 1st April 2019, there's a change in preliminary account environment in which KML operates. This change is allowed in accordance to AS21. Let's look at part A. Advise the appropriate accounting treatment for the change of currency. In this case, I'm referring to functional currency on and after 1st April 2019. First, you have to discuss the basis for the change and the treatment for the change from Indonesia rupiah to US dollar. The change is allowed because there's a change in preliminary account environment in which KML operates. And for the treatments, this is a change in the preliminary account environment in which the entity operates. So the change should be adjusted prospectively on 1st April 2019, which means we have to translate from Indonesia rupiah to US dollar on 1st April 2019. All the assets, liability, equity should be adjusted based on the exchange rate on 1st April 2019. Please refer to the answer. For part A, the issue is change in functional currency from Indonesia rupiah to US dollar on 1st April 2019. In accordance with AS21, an entity should determine what is the functional currency and measure the performance and positions in that currency, which is the functional currency. Give the definition of functional currency. It's a currency of preliminary account environment in which the entity operates. To determine the functional currency, we have to consider the factors given under AS21. We have to consider the preliminary factors, the sales and the cost, and we have to consider the secondary factors if the primary factors is not conclusive. Before 1st April 2019, all the sales purchases, rental, labor costs were substantially determined in Indonesian rupiah. Indonesian rupiah is considered the functional currency of KML before 1st April 2019. In accordance to AS21, an entity can only change its functional currency if there's a change in the underlying transaction event and conditions. In other words, the change is only allowed if there's a change in preliminary account environment in which the entity operates. Since 1st April 2019, KML had been required to purchase and sell in US dollar rather than rupiah. Hence, on 1st April 2019, the underlying transaction condition has changed. and US dollar become the functional currency of KML from that date. KML functional currency have changed to US dollar, and such change should be accounted for prospectively from the date of the change. And bear in mind, there should not be any restatement of previous period. In the year 2019, the functional currency of KML was Indonesian rupiah. It's only from 2020 onwards, the functional currency of KML become US dollar. There's no restatement on the comparative figure. When we say apply prospectively, means KML should translate all items into a new functional currency using the exchange rate at the date of the change, which is 1st April 2019. For non-monetary item, example PPE, intangible assets, inventory, the translated amount in US dollar on 1st April 2019 shall be the new historical cost for accounting purposes for KML. At the year end 2020, we should not retranslate using the closing rate. Given that they are non-monetary item, we should not translate using the closing rate, unless these items are measured at fair value basis. During the year 31st March 2020, all the transactions should be recorded in a new functional currency, which is US dollar, monetary assets and liability, denominated in foreign currency, which means other than US dollar, will be remeasured to US dollar using the closing rate at 31st March 2020. As mentioned earlier, non-monetary item will not be remeasured using the closing rate, instead will be measured at the HR rate, unless the non-monetary item is measured at fair value basis. Income expenses item that is not in US dollar will be translated to US dollar using the exchange rate for the transactions. For practical reasons, we may also use the average rate for recording purposes. All exchange differences will be recognized in profit and loss in 2020 for these translations. Part B. Advise the appropriate accounting treatment if KML would like to change in presentation currency from rupiah to US dollar on 1st April 2019. Before that, the presentation currency is rupiah. To use rupiah as a presentation currency is a choice. If KML have decided to change the presentation currency to US dollar, this is a change in the choice, in the presentations. A change in presentation is a change in accounting policy. If it's a change in accounting policy, we must apply the change retrospectively. In particular, the question wants us to advise the relevant impact to the comparative amount presented in the financial statement of 2020. If it's a change in accounting policy which need to be applied retrospectively, we have to restate the comparative in accordance to AS8 and AS21. For these questions before, the functional currency is Indonesian rupiah. The presentation's currency is Indonesian rupiah. After there's a change to US dollar, from Indonesian rupiah to US dollar, this change is a change due to a change in preliminary economic environment in which the entity operates. This change of functional currency from Indonesian rupiah to US dollar, we have to apply the change prospectively. When there's a change in presentation currency from Indonesian rupiah to US dollar, this change is a change in presentations. If it's a change in presentations, it's considered as a change in accounting policy. If it's a change in accounting policy, we must apply the change retrospectively, which means we must go back to prior year, restate the comparative figure. Let's look at the answer now. Part B, change in presentations. The presentation currency is an accounting choice of entity. When there's a change in presentations, this is in the form of change in accounting policy. Presentation currency is the currency in which KML present its financial statements. It's the choice that the company made. KML had presented its financial statement using Indonesian rupiah. If KML planned to present the financial statement in US dollar from 1st April 2019, this is in the form of change in presentation currency, which means it's a change in accounting policy, which should be applied retrospectively. In other words, the comparative figure 2019 need to be retranslated retrospectively from Indonesian rupiah to US dollar, as if KML had always presented financial statement in US dollar. Take for example, all assets liability at 31st March 2019 should be translated to presentation currency using the exchange rate at 31st March 2019. All profit and loss for the year 2019 should be translated US dollar using the exchange rate at the date of the transactions, but for practical reason, it may be translated using the average rate for the year 2019, especially for examination purposes. And all resulting exchange differences for 2019 should be recognized in OCI. In accordance to AS21, exchange differences arising from translation of operations to presentation currency is recognized in OCI and will be reclassified to profit and loss upon disposal of debt operations. This is the 30 marks questions. Make sure you have in total 14 to 15 points covering Part A and Part B. We come to the end of this session on AS21 and accounting for the effect of changes in foreign exchange rate together with foreign operations, including foreign subsidiary and foreign associate.